Thank you so much for that warm introduction. It is my pleasure to be here to introduce this panel and to have a talk about derivatives, all things derivatives, and especially happy to be in this beautiful city. So, bienvenidos. I'm a co-founder of Immersive Finance. We support options traders and volatility funds on the risk management side. And I have an FX options background, 25 years, so I love everything derivatives and options. And it is my pleasure now to introduce our panel, but I think it's best if we all give a small introduction about ourselves and the companies. Do you want to start?
Start. Hello, everyone. I'm Hendrik, co-founder at Thalex. We're a new crypto options exchange, basically creating hopefully a compelling alternative to Deribit. And what also sets us apart is that we partner actually with other spot exchanges where we make it very easy for their customer bases to integrate with us. And in Q4, we'll kick off that strategy with our first partner, Bitfinex.
Thank you.
Hello, everyone. My name is Anestis Arampatzis. I'm the co-founder of Centaur Markets. It's an OTC structured product desk that is trading options in Bitcoin, Ethereum, and the top 100 tokens. Anything from basic vanilla to structured products. And before that, I used to trade commodities in large sizes for a decade.
Hosting a panel right after lunch may not yield the immediate audience, right? But at least true derivatives warriors are here. So my name is Greg. I managed a global macro fund for 15 years before calling it a day and starting the company in crypto to do Euro stablecoin. We are the biggest and the oldest stablecoin around that pushed regulations from the southern part of Europe into the whole Eurozone.
Hello, good afternoon, bonjour. My name is Jean-Marc Bonnefous. I'm a kind of derivative veteran. I started in commodity derivatives in the 90s in large investment banks and started a management company in London in 2007, managing a number of commodity derivative funds, and we pivoted to effectively digital commodities, aka crypto, in 4.5 years ago, and effectively we are a systematic, long-short, liquid hedge fund.
Thank you very much. And I think that we cannot start this panel discussion without talking about the big news from last week. So we had the SEC approving options on Bitcoin ETFs, spot ETFs, and from BlackRock. So I have a question. What do you think is the significance of this approval from the SEC? Anestis, you want to start?
Yes, this is some big news that everybody has been waiting for. I believe that by allowing Bitcoin options on the ETFs, suddenly the flow in derivatives market overall will pick up by a lot, mostly because the ETF traders themselves will start utilizing options trader strategies for yield or risk management, but more importantly, because many crypto native funds have now an extra source to run arbitrage strategies with. So I believe that down the road, the volatility between the Bitcoin ETFs and the CME will end up normalizing across all exchanges, as most traders will try to be running that arbitrage.
Jean-Marc?
Yeah, I mean, in terms of validation, it's phenomenal, right? We saw the impact of the ETF on Delta One flat price action, and to have the same validation in terms of the largest, deepest capital market in the world, the USA, of an option product, it's phenomenal. Although, I mean, obviously there were already some option markets. There's a CME option contract that does exist. And there are some on the other side of the fence, so to speak, on the unregulated side, there's already a very buoyant option market. But to have this US regulator imprint on that option contract is a massive validator.
Fantastic. Anybody else?
I have to say that that definitely means that implied volatility will became already an asset class of itself. And when people say crypto is volatile, well, guess what? Bitcoin last few years became less volatile than some of the traditional equities. Even before, say, events like NVIDIA earnings release or something, implied volatility on Bitcoin was lower, trading low. That means there are institutional capital that is offering this volatility on the market. And we need credible platforms, exchanges, where that can be bought and sold. So that comes to another question, the legitimacy and the quality of the collateral that is used to input these trades and to settle these trades. We'll address them a little bit later. But it is definitely important milestone, meaning that not just the crypto becoming institutionalized, but the derivative from crypto, implied volatility, is also becoming institutional grade product.
Maybe one quick addition to that point. So to frame it, in 2021, Bitcoin was a 100% vol asset. Now it sort of mean reverts around 50% vol. Sometimes on a slow Saturday, you can pick up Bitcoin vol for 30%. And so now probably, as we've seen with the previous ETF introductions and the ability to sell future term structure, probably you'll see a lot of covered call overriding, further suppressing that vol. And that in turn will actually then unlock a lot more demand for using options to express directional views or hedging. And so a big part of actually options growth is not just that piece of education or certain institutions entering the space. It's also just, frankly, that the cost of carry of options is really structurally going down over the last few years.
But I have a question. So do you see enough adoption of the derivatives market? Do you think, are we where we'd like to be now? Did you expect to see, because you all have been in the space now for a while, so would you have expected a much faster pace of growth at this point?
So, sorry. I mean, in my view, let's take a bit of a step back, right? What's the size today of the derivative market in crypto? If you look at traditional markets, equities and commodities in particular, the derivative market is a big multiple of the underlying spot market, right? In crypto, it is not. It's actually smaller. So if you think of the journey of crypto to mimic a more mature traditional asset, you're going to see a situation where you need an inversion of that volume, right? You need to have derivative market as a way to leverage with paper the size of the underlying market. So I think there's a lot of room to move from, I think the options market, for instance, in crypto is probably 60 billion a month, which is tiny compared to the cash market in crypto and tiniest compared to the option market in traditional finance. So to have those venues, the off-exchange venue, the CME, now the ETF, it kind of gives more depth into the infrastructure to scale that. And because it now addresses different constituents of the market, crypto native will go to Deribit, a mixed crowd goes to CME, and then the US crowd could go to the options in ETF. You're mapping, the infrastructure is mapping much better for future growth, the needs of the market.
But coming back to that, sorry.
So in my opinion, this is a two-sided answer. Can liquidity in the options across all crypto get much better? Absolutely. Is it good enough compared to where the market is currently? I also think absolutely, for two different reasons. Number one, there is lack of regulatory clarity. The majority of the players in the developed countries and markets like the US and the Europe cannot access Bitcoin-denominated options or crypto-denominated options. So you have that arbitrage on CME that is closing 2 hours a day. It doesn't really work. At the same time, one thing that many people forget in crypto is that out of the $2 trillion, let's say half is altcoins, more than 60% of those tokens are still locked in safts. So the reality is that you have locked tokens that you need to utilize cash flow outside the token with the risk of the token rallying against your dollars and being margin called multiples. And this is something that is actually preventing the market on the alts from picking up, simply because out of that 1 trillion, less than 400 billion are actually liquid to be traded against derivatives.
I can give you even a number. So when the front month volatility of Bitcoin will reach sort of gold level, then you can say it's enough. Now we're just starting.
Fantastic. On that same note, we talked about what would it take to really, really bring financial institutions to the space? What is it lacking? Do you see, because I think that financial institutions, I would say, are only tipping in with ETFs, maybe with options. So what is it that we're lacking?
I think if you look at the institutional adoption, we have near 100% adoption of proprietary traders, so people who trade their own money. And usually those specialize in market making. And so crypto is already extremely mature in this use case of, let's call it high velocity trading. Look at Binance. If you look at volume to open interest, it's barely drops below 2, right? So it's basically a lot of retail using perpetuals as kind of these zero DTE options, and market makers taking the other side of that. And it's fantastic flow for them. It's incredibly capital efficient, and they can buy and sell innumerable times each day. And so every large market maker in TradFi is basically already in crypto or about to. I think where you see much less adoption is in lower velocity types of trading. Think of like a Brevin Howard style hedge fund that would use derivatives, futures and options to express like complex views, maybe relate to also macro conditions. And because the problem there is that when you go to trades that have longer durations of holding, right, you're still often locking up a lot of collateral on exchanges, and for a lot of institutions, they're absolutely still not happy with the counterparty risk that involves.
So shall we talk a little bit about the collateral? Shall we? Or?
Can I just finish on what will be the killer use case for options to scale? I think if you look again at the traditional markets, sorry to go back in time, but there's two things: it's hedging and yield, right? So you can hedge with options, and I think this new instrument is going to allow some people who cannot hedge today to hedge. And then even more crucially, you can create yield. I mean, the biggest use of traditional finance in option is to sell upside to increase yield, right? Look at the bond market. Bill Gross spent his career selling all he could of upside calls on bonds. So in commodities, you can do that. So all these people who have now bought the ETF, they'll be able to create a yield by selling belong the ETF, sell the call. And because it's the same stack, I think it's going to happen in a more agile manner than if you have to buy your ETF and sell the CME or sell the derivative. So it's all about capital. What ties up also these two big use cases will be capital optimization, because the brokers now in the US will be able to cross your margin on the ETF option and the CME option. That's something that cannot happen today on off-exchange like derivative markets. They're a little bit insulated from capital optimization. So those two use cases plus that capital optimization is a good springboard for growth, I think.
And to finalize a little bit the thought, I think we kind of try to overrun whenever you say, what does it take to bring the large institutions? Before we even try and get there, we need to figure out what does it take to actually educate the crypto native market on utilizing derivatives. You know, how do we need to train the Bitcoin miners to figure out how to hedge? How can we teach the foundations the importance of risk management, you know, both on the Bitcoin Ethereum level, but also on the native token? The financial institution will not come unless you have regulatory clarity. Like, people sometimes fail to understand that if I'm an $80 billion fund, on my PPM, I already explain in extreme detail what I can trade and what I cannot trade. So if as a US government, you cannot define what is an altcoin and what is not, I will never take the risk of putting $50 million of a small alt position because it will jeopardize the legality of my full $60 billion fund. So unless there is full regulatory clarity, I think as an ecosystem, we should focus on training the crypto native people on utilizing derivatives, and that will bring the regulator on trying to actually better determine the value of these assets, and then the larger TradeFi players will come and start playing.
So if I can paraphrase you, you're saying that there is quite a lot of liquidity yet to be unlocked within the crypto system itself, ecosystem, both in terms of actually the altcoin market, but also within all the funds which are holding all these tokens. Yeah, so there's quite a lot of upside opportunity in terms of these players coming in. That's one point of view. Yeah.
Yeah, I have to mention that there is also a problem with the dollar stablecoin collateral, because the dollar stablecoins are not a legal claim on the issuer. So besides just the regular implied volatility you're trading, you have a credit risk of the issuer itself, and then you've got a risk that that stablecoin will not be settled into fiat. Now the dollar settlement is so congested, and Fed recently issued a warning to United Texas Bank, which served 70% of dollar settlement. So until there is a clarity in US, like what is a dollar stablecoin, how is it regulated, how to calculate the credit risk associated with that stablecoin, definitely exchanges like CME will have a massive advantage over all other derivative exchanges in the form of institutional adoption. Because if you're running an institution, you cannot risk your career trading the instrument which has all these internal risks inside. To some point, there are euro stablecoins and MiCA regulation in Europe which solves that, right? But they're not at the level of adoption that dollar stablecoins are.
So, but MiCA helped with that, or hindered?
Yeah, because it creates a legal claim on the issuer. So a euro stablecoin, you always know you can go to court and liquidate all the assets of the issuer which are transparently segregated and audited. With the dollar stablecoins, nobody owes you anything. It's a goodwill of the issuer to send you money. But how good is that will if they cannot send the money? Because the bank may not be willing to send money in exchange for the cash or stablecoins. So that has been a problem for a while, and all the market makers know in order to settle dollars into stablecoins and back, you sometimes have to pay huge premiums. And it may not work tomorrow until there is legal clarity in US.
Do you agree with that, Hendrik?
To some degree, but I think the issue with stablecoins is much broader than like themselves as a product. They have these massive network effects. If you look at Tether, it's the main stablecoin used for settlement of derivatives, and Binance already tried to get sort of rid of Tether and replace it with other stablecoins and failed. And I think actually if MiCA is essentially pushing Tether settling derivatives exchanges out of Europe, it's just gonna, I think, displace a lot of that that execution just outside of Europe. And so there's also then with some of these stablecoins, Tether and USDC, also a network effect in more and more like real life use cases. And I think breaking those network effects is very hard. So I actually think that...
Yeah, but we are talking about institutional grade risk management. So if you're trading for State Street or like big Standard Chartered or other banks, you would not touch these instruments.
Yeah, I think though that a lot of these sort of institutional guys, they seem to get more and more comfortable with stablecoin liquidity, and they're much more interested about like de-risking lack of liquidity than de-risking the stablecoin in my experience.
So we're maybe... It's interesting because we were talking about derivatives and yet we ended up talking about stablecoins. So we see how there are so many components to understand, but there are many players who are very comfortable within that space. And from what I hear you, more and more players are getting comfortable either through regulation or through other mechanisms, perhaps, in terms of the trading. But I want to come back to derivatives, so a little bit, and talk about the basis trade. So maybe somebody can explain the basis trade, maybe Anestis, you want to explain the basis trade in simple terms to everybody, and why does it exist in crypto? And is there going to be a point where it's going to be stopped being profitable?
Absolutely. So essentially, taking it a step back, in the commodities markets, we have the price of spot, and you also have the price of what you think it would cost to buy or sell the commodity at some time in the future. And that has been happening because since the old days, people that were trading spot commodities, they were trading in what's called forward contracts, where they would lock the quantity of the trade, but not the price, and they were able to utilize the futures curve in order to hedge retroactively at the price they wanted. So the cash and carry trade on Bitcoin is very simply the trade where you buy spot and you go and sell a futures contract at whatever duration you want, 6 to 12 months out, and you're actually capping that price difference. Right now, because everybody is bullish Bitcoin, every forward price on the futures market is higher than the price of spot. So essentially, what does that mean? If spot is trading at $50,000 and the September 2025 futures contract is trading at $55,000, that's 10% higher. So the cash and carry trade is where the trader buys spot at 50,000, sells the equivalent amount of the September futures at 55,000, and at expiration, you make that 10%.
Risk-free?
There is price risk-free, there is always counterparty risk. And this is something that I always like touching. When somebody says it's risk-free, that refers only to price. The largest risk in crypto is counterparty risk, not price.
And then, of course, market knows like silver corner and nickel corner. I mean, you name it. Once in a while, every commodity goes haywire, and sometimes this spread expands to massive numbers.
Absolutely. So essentially, this trade is risk-free as far as you are not willing to unwind it until it expires. Because during the duration of the trade, the future might go significantly higher than the spot, or vice versa. So as far as you're backing it by 100% one-on-one and you don't lift it till the end, you are okay. When it gets funky is when people try to trade around the trade, and this is when you usually see people blowing up.
But be careful, oil traded negative.
I have a question for Jean-Marc. What do you think, Jean-Marc, about the basis trade? Will it last forever?
So I've traded commodity basis trade for 20 years, and it can surprise you. It can flip from contango to backwardation. We talk about contango here. When the back of the curve is higher, tomorrow is higher the price than today. But the reality is that it can spike, the front can spike because there's a shortage of the short-term spot, and then you got backwardation, then you don't make money on that basis trade. So it's a nice trade, but it's transient. It's not going to give you, if you're a fund, for instance, okay, there are years where you can make money on the basis trade, and years you won't make any money, right? You have to find something else. So you have to be aware that it's a very volatile pattern in structure. And I would say, trying to think about crypto, it is possible that the advent of the ETF and the option ETF could compress the basis trade, because they're going to, if they do what I said earlier, they do structured paper on ETF, right? If 5% of the ETF holders on Bitcoin today start doing structured trades, like reverse convertible, I mean, you name it, right? And then basically selling vol, you're going to have a push down the basis trade. So I'll be interested to see how the basis trade looks like in 12 months.
I want to add something very, I think, important for the Bitcoin specifically. It's the only cash and carry trade you can do in commodities where you can actually post the underlying commodity as collateral. Because if you want to do the cash and carry trade in oil, you can buy the physical oil, let's say you are BP, you can sell the forward 12 months out. In the US, it costs $1 a month to store a barrel of oil. So as far as the 12-month forward is trading higher than $12, you have that risk-free premium. The problem is that if the market goes against you, you need dollars to back the futures hedge. While Bitcoin is the only commodity where essentially I can buy the physical and post it on the exchange as collateral against the trade and minimize the margin call.
Super interesting.
Yeah, one more thing about the basis trade is also, I think we've covered the mechanics here very well, but you also have to sort of figure out the starting point as to why is a perpetual or a future usually trading at a premium, right? Because if you look at Bitcoin as a financial commodity, risk premia of counterparty aside, there's actually not really like a meaningful cost of carry. And so there's actually structural reasons why it's actually upward sloping. In regulated markets like CME, like Bitcoin futures were really used as a way of market access, and there was more demand on the buy side than sell side, and so that pushes up that curve. But as you again get things like ETFs, right, it actually lowers that use case of having basically Bitcoin futures as a substitution for owning spot. And on the side of like all the retail exchanges like Binance, Bybit, etc., it's really the fact that these retail guys have usually more demand for buy-side leverage and sell-side leverage. The price then stabilizes above index, and usually funding rates are paying the people who sell perpetuals. But that's really like something that lasts as long as also that retail crowd does not get more educated about how costly it actually is for them to carry these contracts over time. And you start to see like stablecoin projects like Ethena stepping in there and providing a lot of sell-side liquidity. Then you have things like staking yields, which actually add a sort of like a positive carry to the trade, which again also, both of these factors should again then start actually putting pressure on the curve. So if I think you look out 5 years from now, you expect these yields really to compress over time. And so if you're a retail trader, I would say it's still a very good trade to put on yourself at home with a bit of Bitcoin, sell a perp, keep the risk relatively limited, but there's like a very healthy risk premium there that is there still for structural reasons, but I think it's going to disappear over time.
Well, we a lot to talk about basis trade here, but in essence, it could be picking up some sort of inefficiency in the market, which eventually will disappear. So it is an opportunity at the stage where we are now, actually, in crypto, for many reasons. But I want to move back now to talk about regulated versus unregulated exchanges. Who's winning the battle? Yeah, because as you know, all the exchanges in crypto started on the native side, on the crypto native. They kind of, what do? They break and then ask for forgiveness. Where are we? Because there are quite a few exchanges coming on, which are trying to become regulated, following the rules within MiCA, within everything around. So what are your thoughts on that?
Well, in my opinion, obviously there is no shame in saying that Deribit is right now the largest exchange in crypto. And there are many new exchanges that are coming actually, and we need competition in the space. You need more than one exchange, especially if the market is so big. The regulated versus unregulated also is not also 100% accurate, because when you mean unregulated, you mean not regulated in the US and Europe, because all these exchanges are regulated somewhere, right? I believe that as of now there is a tie, simply because the crypto native exchanges are winning on volumes, but they have a massive hurdle in being able to access US and Europe, while the TradeFi exchanges have the access to US and Europe, but then you cannot deliver the spot, you cannot actually trade 24/7. So there is kind of a tie, and whoever tries to cap the gap in between the two will be the winner. You also have many new exchanges that are actually coming with a clean plate, and I would bet on those as well.
If I may say, for regulated and unregulated, it's like a meal. I want my cheese and my pudding. I want both, because it serves different purposes and different use cases and different client base. If I have a fund in Cayman Island and I'm trading for LPs who are effectively specialists, if you wish, or native to the market, I don't need regulated, because the setup today allows us to do that. If I want to grow and have a pension fund in my fund or my business, I want regulated. So I think there's a two-tier market that is going to grow, and this regulated framework is going to grow probably faster over the next few years. But in addition, I don't expect the unregulated market to completely disappear. I mean, it's a huge market and it fits a purpose. And a lot of those who are using it don't want the regulation. So why would they move to the across the? So it's plus to me. I want both.
Yeah, well, let's just mention that BlackRock just amended their agreement custody with Coinbase to settle physical Bitcoins in 12 hours after the trade. That just gives you a sense that there is no such thing as regulated exchange yet, properly regulated one. So keep to the point that not your keys, not your coins is probably the safest risk management argument for now.
I'm going to throw one last question before we wrap up the panel, a controversial one. But a lot of the stickiness comes as well from a counterparty risk against the exchanges. Have the native PBs, are they managing to sort of solve that problem? So the prime brokers, do you think that there are solutions in place? What are your thoughts?
Well, personally, I believe that there are solutions in place, but those won't come from clearing houses or PBs. I believe the custodians will come in between and offer that solution. You have the Go network with Bitco, you have Clearloop with Copper, where essentially more and more people are actually trying to settle off exchange in an escrow type style accounts. I see many reasons for why the large exchanges do not want this, but at the same time, I see many young exchanges trying to do everything they can in their power in order to generate volume. So I believe that down the road, we will see a hybrid of off-exchange trading through custody in escrow-style accounts.
Well, most traditional prime brokers and banks are not providing any haircut or any leverage for Bitcoin ETFs and others, so we're still far from it. So it's just early days.
Yeah, I mean, there are efforts to provide credit effectively. What we talk about is credit. Prime brokers there is, but I call that prime brokerage light. The full fat prime brokerage with credit is very difficult to find. And the reason is what said earlier, the market has not learned to price crypto risk, crypto counterparty risk. It's not comfortable with it. Banks are certainly nowhere near. And I think I would venture to say that this ETF option might teach the prime broker who are going to have to use it, right? Teach them to price collateral exposure risk on crypto asset on the regulated side. And then they'll cross it with CME. So we're going to see some prime broker in the US doing optimizing CME to ETF option collateral. And all that participates to them learning how to price crypto risk. And I think it's going to benefit all of the crypto industry that some traditional players will start to come and say, okay, I can live with that volatility after all.
Yeah, I think that kind of sums up a lot of the general thinking in this panel, which is that you can hedge market risk, but you cannot really deal with non-market risk except for position sizing smaller or maybe just having general capital buffers in place. And I think that's just the same thing that underlies this whole prime broker discussion. Is like to really get efficient, for instance, leverage, cross-exchange, cross-margin. The issue is just that every exchange is its own little clearinghouse right now, and so it's really like a network of counterparty risk that is keeping this prime brokerage market subscale right now.
Well, we are running out of time, but I would like to leave on a positive note. So if anybody can give me like 20 seconds of your thoughts about where are we going with derivatives in crypto?
Well, personally, I'm very bullish Bitcoin, and in under certain circumstances, crypto. I look at Bitcoin as modern digital gold. I look at crypto as tech startups, where I believe that the broader macro environment has a lot to do with their success or not. But overall, I'm very optimistic and bullish for the near future.
Well, I think institutionalization started 2014, became noticeable 2017, accelerated 2021, 22, 23. So implied volatility of Bitcoin is going to the range of gold. That's the target for the next years.
Yeah, I think what amazes me is that the infrastructure built over the last 4 or 5 years has been amazing. The volumes have not yet met the infrastructure that we have all collectively built. Or I see some nice progress in the US towards that with the ETF flat price and option. So I'm quite confident within 5 years we'll get to those multiples where the paper market, the only way to grow the crypto market is by the paper market, right? It's not, the Bitcoin cash is not going to grow much. It's limited, but the paper can make it 10x. And I think
derivatives, yeah.
If we do a 10x in 7 years, I'll be very happy.
Yeah, I think so. To that, I think especially what we talked about earlier, like this emergence now of these overriding flows where you can sell upside calls, and potentially you can also start doing in crypto then the pension fund trade of like selling upside calls, buying downside puts, is a great way to then like manage long underlying exposure over time. And so I think yeah, the future is like a lot larger penetration of options and much more interesting volatility products that will then come out of a mature options market.
So in other words, the future is bright for derivatives, yeah? Thank you very much for your time. Sorry we ran out of time. We
you.
covered many topics at speed. So please welcome in thanking the panel. Thank you.